God dag og velkommen, kære lytter til Peters Guldkorn, en pod... God dag og velkommen, kære lytter til Peters Guldkorn, en podcast om guld og investeringer. Mit navn er Peter Kyhn, og jeg er din vært i denne guldvandring gennem markeder og investeringer. Lad mig først spørge dig, hvad gør du med din boliglån, hvis renten pludselig stiger 5%? Hvad gør du med din pension, hvis aktiemarkederne falder sammen som en soufflé? Hvordan beskytter du dig mod økonomiske kriser? Hvad kan afbøde krisens effekter for dig i din økonomi? Svar på disse spørgsmål får du lidt senere her i Peters Guldkorn. Endnu en gang velkommen til Peters Guldkorn, en podcast om guld og investeringer. Mit navn er Peter Kyhn. Puha, sikken en måned vi har haft, hvis vi der investerer i fysisk investeringsguld. Målt i danske kroner er prisen på guld i løbet af den sidste måned faldet med hele 75 kroner for en troy ounce og kommet ned under de 8.000. Og ser man på toppunktet i løbet af den sidste måned, så ligger guld 110 kroner under. Lad mig lige oplyse, at en troy ounce, det er det traditionelle mål for guld, også for sølv, det er 31,1 gram. Ser man på prisen i amerikanske dollars, så ser det ikke så slemt ud. Men guldprisen er alligevel faldet stødt de sidste 3 uger, så den ligger nu på lidt over $1.300 for en troy ounce. Vi, der investerer i fysisk guld, har med andre ord brug for noget opmuntring, og det er lige præcis, hvad jeg har bragt med til dig i dag. Vi har nemlig den store glæde af at have økonomen, professor Dr. Krasimir Petrov, med os i studiet i dag. Vi har faktisk fløjet ham ind fra de arabiske golfstater, hvor han har slået sine folder. Og Krasimir Petrov, det er ikke en hvilken som helst makroøkonom. Han er, som det fremgår af navnet, oprindeligt fra Bulgarien, men han har taget sin doktorafhandling på Ohio State University i USA, og siden da har han undervist på en række universiteter rundt omkring i verden. Mere interessant er det, at han siden begyndelsen af 00'erne, både professionelt og personligt, har været interesseret af guld og gulds mulighed for at bevare værdi over tid, sammenlignet med andre investeringsgoder som aktier, obligationer, fast ejendom osv. Og endnu bedre er det, at han er en lidenskabelig vidende og fantastisk engageret taler om disse emner. Professor Petrov har koncentreret sig om økonomi og guld, og ikke brugt sin sparsomme tid på at lære dansk, så vi fortsætter resten af podcasten på engelsk. So, Professor Petrov, welcome to Peters Guldkorn.
Thank you very much.
Which is the name of the show, and it's called Peter's Grains of Gold in Danish.
Okay.
So, I've just listened to your fantastic presentation at Dansk Aktionærforenings investeringsdag here in Copenhagen today at SAS Scandinavia Hotel, and it was fantastic. It was a great presentation. You had lots of interested people there, and there were many questions. It was really a top presentation. I know your background. Tell me, please, why is it fundamentally in this day and age that people should invest in gold?
Well, this day and age, we have forgotten what gold is and what gold means. That gold has been for 5,000 years the foundation of money and monetary systems around the world, from Japan and China to Europe and America. Gold has been the foundation of money. Later on, with banking systems from ancient Rome and so forth, gold has been the foundation of the banking systems. Gold has good intrinsic values which make it the perfect, meaning the most suitable form of money. And only gold presents the best basis for building a banking system. When a financial system and monetary system is not based on gold, eventually bad things happen. Eventually, under the pressure of government, the central bank overissues the currencies, usually prints a lot more money. The currency begins to lose its value. We call this currency depreciation. The banking system eventually begins to credit and creates an unsustainable credit boom. People get to invest and speculate in unreasonable forms of investments, usually real estate and whatnot, and eventually it leads to a monetary and banking currency and banking crisis. So all fiat monetary systems sooner or later, usually in cycles of 10 to 30 years, experience crisis. A good example, the best example is Argentina. For the 20th century, they've had between 9 to 10 currency crises. Every 10 years, they go through a currency and a banking crisis. The economy stabilizes, they get the monetary banking credit boom going on, and within 10 years, they get a crisis. And America is in a similar situation, and all countries that use paper money as money and use a banking system based on paper money eventually, usually within 10 to 20 years, go through a crisis. Unfortunately, paper money is not stable, it's inherently unstable. It is subject to over issuance. Banks rely too much on paper money. They provide too much credit and rely that in bad times they will get bailed out, and they over issue credit. In other words, they saturate the credit with the economy, and most of that credit turns out to be unsound. When that credit cannot be repaid back, the result is a banking crisis too.
And gold is the antidote, the cure for most of those woes that you mentioned here.
Absolutely. Gold is the antidote. It is the sound value that has value, that remains value, that sustains its values not for decades, not for centuries, for millennia, for thousands of years. Gold preserves its purchasing power in terms of shoes and clothes and housing, and gold is the antidote. Unfortunately, governments don't like gold because gold restricts government's ability to run fiscal deficits. They cannot print as much as they want. Gold is also highly restrictive in terms of credit. Banks cannot extend too much credit when the monetary system is based on gold. And governments cannot overborrow and get too much in debt when the monetary system is based on gold. And therefore, governments hate gold. And therefore, governments do everything in their power to keep gold out of the banking and monetary systems and to effectively demonetize gold. And they've been quite successful since World War II to demonetize the world. And it is not a coincidence that since World War II, especially in the 60s, the world has been going on through one financial crisis to a next financial crisis every 3, 5, or 7 years. And each crisis is bigger and worse than the previous one. It's papered over with more money printing, more credit, which lays the foundation for the next bigger crisis. And right now in 2018, we're at the current situation is that the current banking, monetary, credit, currency conditions are significantly worse than they were in 2008. Stocks are a lot more overvalued and speculation is bigger. Real estate is significantly more overvalued than they were in 2008. Banks a lot bigger and better, meaning a lot bigger with too much bad credit. And bonds are significantly overvalued. In other words, by every single investment and macroeconomic and credit indicator, today's monetary system and economy is in significantly worse shape than in 2008. The reason is that governments did not make all the corrective actions that were needed to fix the fundamental problems in a fundamental way at the root cause, but instead all they did was give more credit, print more money. We call this, they papered over
Mhm.
the problems with more paper, okay? And the result is now the situation is a lot worse than it was 10 years ago.
Mhm.
And when the next crisis comes and we have too many indicators to see that the crisis is coming soon, maybe within 3, 6, 9, or 12 months, it will be a lot worse than it was 10 years ago.
Mhm.
And 10 years ago was a lot worse than the crisis before that in 2000, 2001 with the dot-com bubble, which was a lot worse than the 97, 98 Asian financial crisis,
Mhm.
which was a lot worse than the 1994 Mexican crisis, known as the tequila crisis. So each consecutive subsequent crisis is bigger and worse and lays the foundation for the next. And now, for the last 10 years, we've laid the perfect, unfortunately,
Mhm.
foundation for the next much bigger crisis, probably much worse in human modern Western history than before, because all Asian economies have already been involved in these bubble activities.
Mhm.
Bubbles in Singapore and Hong Kong and China are all horrible. They are just as big and just as bad as they're in London, in New York, and here in Copenhagen, and of course in Stockholm and all over the world. Now we're living through a global financial bubble, global stock market bubble, global
Mhm.
real estate bubble, global bond market bubble.
There are no areas in the world that are, so to speak, bubble free anymore.
Not true.
True.
Commodities
Yeah.
are still bubble free in the
Yeah.
sense you don't hear very many people investing in palladium. Not at
Mm.
all. You don't read anybody investing in uranium. Certainly not. There is not much or any speculation in rice. Rice is not really expensive. In other
Mm.
words, there is not much speculative fervor and activity going on in commodities,
Mm.
not much or at all in gold and silver. These have not been yet part of the global financial bubble, and therefore they are significantly undervalued. And therefore, commodities in general, and gold and silver in particular, provide a significantly better protection in coming years for the coming crisis.
Mm. Speaking about value, you mentioned at your presentation that you like to compare the price of gold with the stock prices.
Correct.
Gold to Dow, you mentioned
Yes,
Dow Jones Index.
yes, we call it, it is well known and said is to be the Dow Gold ratio. So if
Yeah.
anybody writes on the internet Dow/gold ratio or Dow-gold ratio, there are thousands of articles about it. Dow Jones is an indicator of the stock market, and the stock market is a good proxy for all financial instruments, all paper assets. Gold, on the other hand, is a proxy for real assets, for commodities. And therefore, Dow represents the financial sphere,
Mm.
gold represents the real sphere. And right now, we have a huge disproportion where the financial sector, all financial assets are grossly overvalued,
Mm.
and real assets like rice and copper and zinc and oil and gold are relatively cheap. On average, historically, 5 to 10 times cheaper. There is no speculative fervor. They are
Mm.
relatively undervalued. For stocks and bonds, we say they're relatively overvalued. Now, because bonds are relatively overvalued means that the interest rates are artificially low.
Mm.
Now you can get an extraordinarily dirt cheap mortgage like you never can get before. At 2, 3, 4%, you can borrow money to buy real estate. So this overvaluation of bonds resulting in dirt low dirt cheap mortgages
Mortgages.
has resulted in turn has spilled over into real estate, has resulted in a global real estate bubble, and real estate is now, I've been calculating in my home country, Bulgaria. We just calculated in Estonia and in Finland. We also calculated here. Real estate is roughly about 3 times overvalued. Maybe 4 or 5 times in Australia, maybe about 5 times in Canada, maybe as much as 10 times in China. So real estate is anywhere between 3 and 5 times overvalued practically everywhere in the world. The one exception would probably be Japan, because Japan had an insane real estate bubble that blew out proportion in the 90s. The bubble burst in 1990 and has been deflating ever since for the last 28 years. So real estate is not as overvalued in Japan, and it's probably not as overvalued, or at least was not as overvalued in Eastern Germany. Eastern Germany is special for a completely different reason. During the unification, Eastern Germany blew at a time in the expectation of unification one of the greatest real estate bubbles ever known, because the expectation is that when they enter Germany, get unified, their real estate will be as high as Western Germany's real estate. And of course, it didn't turn out that way, just like Bulgaria's real estate, in the expectation that we're going to join the European Union, was blown out 2, 3, 4, 5 times out of proportion. Because if we enter Europe, our prices in Sofia will be just the same as in Berlin, Rome, and Paris. But that didn't happen either. And I explained to people, hey, Ohio, where I got my PhD from, has been in America for 150 years. But real estate prices in Ohio for the last 150 years are 3 times lower than New York. And nobody in their right mind would expect that Ohio prices in Columbus, Ohio, will reach New York levels. Why do you expect Bulgarian Sofia prices to reach Paris levels? Why would you expect Eastern German real estate prices to live Western German standards? But that's a different topic for another time. The point is, currently 95% of the world is engulfed in an insane real estate bubble.
And gold could set you free from that. So
In a
the
sense.
thing is not to go out and get another mortgage and buy gold for that.
No. If you want to protect yourself financially, you sell your property and buy gold. You sell one of your 2 or 3 properties, or 2 out of 3 properties, and convert it all into, or most of it into gold. Yes, that's if you want to be. Again, we're discussing what is the global financial situation, and then now you're switching to a completely different topic. If I'm an individual, how to protect myself? That's a very big topic if you want to discuss. For the individual, the good protection will be 20, 30, even up to 50% of their personal wealth to be stored, stashed somewhere in gold and silver, away from the financial system. Now, what will be a very good, proper portfolio for an investor? Now, the old Jewish rule, which is still very decent, is you put 1/3 in cash, you put 1/3 in real estate, and you put 1/3 in gold. Now, I do believe, and I've studied a lot, it's a little better, or a lot better, to divide it into quarters. You put 1/4 in gold, 1/4 in real estate, 1/4 in cash and bonds, and 1/4 in stocks. This will be the uniform, balanced portfolio. If you believe that stocks are relatively undervalued, you raise your 25% to 35%. Okay. If you believe that stocks are somewhat overvalued, you lower the 25% down to 20 or 15 and you raise your gold. In other words, you keep a relatively balanced portfolio, and what you believe is somewhat overvalued, you reduce the percentage from 25 to 20 or 15, and those that are undervalued, you raise a little bit to 30, 35%, but you still maintain a relatively balanced portfolio, and you keep rebalancing. If, let's say, you invested in stocks, your stocks went up, you'll take money out of the stocks, put it in gold. I was explaining today the opposite situation. If gold goes up, 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 and up, you take some money out of the gold and put it back into stocks if stocks went down. Or you'll put it in real estate if real estate went down. So what I was explaining a little bit with real estate somewhat overvalued, you may want to reduce from 25% your portfolio in real estate, lower it down to 20 and put those 5% in gold. Again, you believe, or if you're afraid a little bit of the stock market, don't keep 25%, reduce it down to 20% and add another extra 5% into gold. So in the current environment where I believe stocks are relatively overvalued and bonds are relatively overvalued and real estate is relatively overvalued, I'd balance the portfolio more to raise the gold share up to 50% and reduce the others to roughly about 15 or so. Okay. And also in these riskier times, maybe an investor could increase a little bit of cash. Why not? So you can keep still 30 or 40% in gold, and you can increase your cash position to 25, 30% too. To be on the safe side, to sleep better, not to worry that the stock market crashes. Or if the stock market crashes, you're invested at 20% and the stock market crash wipes out half of that, your gold will more than compensate for it. But it's better. You have the cash on the side to buy more stocks if the stock market crashes. Now, if real estate crashes, you'll have the cash to buy more. In other words, in a balanced portfolio with gold, no matter what goes down, you got a good move. No matter what goes up, you got a good move. In other words, no matter what goes down, you can buy a little more of it to stay balanced. No matter what goes up, you can sell some of it and buy something that's become relatively undervalued.
Yeah, fascinating. So, where are we right now in this situation? You mentioned that.
You have to clarify, where are we with what? You mean with Donald Trump? America is already great
No,
again. He made America great again.
That's fantastic. But I was thinking of the cyclical moves and yeah.
Of what?
Of stocks, for
Okay.
example.
Okay.
Yeah.
Stocks, since 2009-10, they've bottomed out. They're already 100% up. They've gone high. Stocks are slightly more overvalued than they were in 2008. And before they crashed. Stocks are now slightly more overvalued than in 1999 before they crashed. Stocks are just about or slightly more overvalued than in 1929. So stocks right now are more overvalued than at any time in modern history, the last 200 years. And I have a lot of charts and graphs to show for those who want to see a little bit more. I had a presentation called It's Worse Than 2008, where I provide all the charts and the data and everything else. But stocks are significantly overvalued. Yes, they may go for another 3 months or 6 months or 9 months up. You cannot possibly predict the peak, but they're so overvalued that's keeping more than 10 or 15 or 20% of your portfolio in stocks is way too risky. They're way too expensive. The returns of stocks are too small. The dividend yields are too small. It is just not worth the risk. Now, if you invested after the crash of 2008 and 2009, stock market crashed 50, 60%, that would have been the right time to buy, not now. Now, stocks are very late in the cycle where they're too overvalued and too risky and not worth the risk and not providing the returns. We are very similarly in the bond cycle. Bonds market has been going up for close to 30 years. Well, sorry, 35 years. Bonds yields peaked in 1980 to 1982, depending on whether we talk about short-term or long-term bonds. So from 82 until 2017, that has been roughly about 35 years. Bonds have been in a bull market. That was way, way, way too much. We're not late in the cycle. We're at the end of the cycle. Investing in bonds is practically suicidal at this point in time. You're not going to gain anything. You got little to gain. Exactly 2% per year, which is a big, bad joke. And at the same time, you have a lot to lose. In bonds, you can lose during inflationary times a lot more than you can lose in stocks, because on bonds you lose twice. You lose on the inflation side and you lose on the interest rate. When interest rate on a 10-year bond goes up by 5%, the bond can easily lose 40% of its value, plus inflation eats away. From 1970 till 1980, for 10 years, when there was a very high inflation and rising interest rates, investors in bonds lost between 80 and 90% of their money, of their value. In stocks, they lost only 60%. In other words, in stocks, they lost about 2/3. In bonds, they lost a lot more. So, bond cycle is extremely late, probably at the end. Probably we have already seen the peak of the long-term bond market, the 10-year bond market, and we're probably on the down leg now. And it will be probably on the down leg for the next 10, 15, easily for the next 20 years, when interest rates will be going up and bonds will be going down. With real estate, we're also very, very, very close to the end. Real estate market correlates highly and is driven highly by interest rates. So if we're very late or at the end of the bond cycle, real estate is also very late or at the end of its own cycle too. So we're at the end of 3 major cycles, and we're in an intermediate step when it comes to commodities and when it comes to gold. The cycle began in 2001 or 2000. Stock market peaked long term in 2000. And at the same time, the commodities in gold bottomed out in 2000. Then they had a first major leg up from 2000 to about 2010, 10 years up, or let's say 2011 or so. Then they had about a 4, almost 5-year correction for gold, for oil, and for most other commodities that basically resulted in 30, 40, 50% for oil, even a lot more correction. The oil was 80%, 75, from $145 down to $25. Oil was down 5 times. Even now, at $50 or $60, oil is still very, very cheap. So I personally expect that we're in the middle of the commodity cycle, which began in 2001 to 2010, 12, had a 10-year up leg. It had a 4-year major correction. From the last 2 years, let's say 2015, most or all commodities have bottomed out, And I'd expect anywhere to have another 8 to 12 years of a leg up of another bull market. This leg up usually will coincide with a leg down in stocks and bonds and real estate. They usually synchronized,
Mhm.
negatively correlated.
So, but aren't we at the root of this? Many of the rising prices in assets is the propensity of governments to print money to
Yes,
to to
absolutely. It's
produce more money. But
yes,
aren't we in a situation where everybody is sort of you know more or less in captivity by the other party? I mean, as soon as something happens, off they go to the printing press to print more money,
yes, of
and
course.
but is there any sign that this will ever stop? I mean, this is a fundamental um, issue here because I mean,
Yes, there is.
philosophically, people could
Yes,
print money till the end of time.
the short answer is no. It is not possible to print money till the end of time. Sooner or later, overall inflation begins to catch on. We
Mm.
see now the inflation in real estate. We still now see now the inflation in healthcare. We see now the inflation in education.
Mm.
From 2005, 6 until 2008, we saw the inflation in all commodities. In other words, as people get to see that governments print more and more, and inflation catches on, and they get to see that bonds don't protect and the stocks don't protect like they saw in the 70s, they begin to move to real assets. They begin to move to
Mm.
copper, zinc, steel, rice. In other words, as they move to commodities, they drive commodity inflation, which in turn drives consumer price
Yeah.
inflation. And as consumer price inflation goes on, people start taking their money out of the bank and out of the financial system and out of stocks and out of bonds and invest even in more commodities. And this is exactly what happened from 1990 till 1997 in Bulgaria, in Russia, and this is what happened in the 70s in America.
Mm.
So
Western Europe.
this cycle eventually ends with more inflation. Now, the, there is also a possibility that some of the Western world will not like to make all the necessary changes. And we may enter a 20, 30, 40 year of a depression and stagnation, Japanese style.
Mm.
Japan has been, and people, I still don't understand why they keep talking about the lost decade in Japan. Why didn't now that the Japan has lost
Three
almost
decades.
3 decades now. From
Mm.
1990, Japan has not made any changes. They have just kept bailing out businesses. They have just kept bailing out no structural changes. And yet Japan has been going down and down and down and down for 27 years. And every single year, corporate debt is getting worse and government debt is getting worse, and Japan is currently one of the most, if not the most, over indebted nation in the world. It is certainly the most over indebted government, and eventually it will blow up. But they can postpone that process for a while. And again, just like Rome, it may, the country, the economy does not have to recover. It may be in depression for 100 or 200 years. Or it may be like Argentina. Argentina was significantly better developed than America
Mm.
100 years
It
ago.
was.
And it could be on a 100-year decline and getting from bad to worse, and it can keep going down and down. There is no end to how worse things can get. So, essentially, there are different routes, but unless the foundational problems are solved, one way or another, problems will be worse. Now, America, things were going so bad in the 70s that eventually they had to elect Ronald Reagan. Paul Volcker had to raise interest rates to fantastic 22 or 25%. Long-term bonds were yielding 18% to really choke all credit in the economy and to purge all bad businesses, all bad credit. In other words, the financial system in the economy needs to go through the cleansing process where all bad and inefficient businesses are driven out of business to be replaced with better, more competitive industries and businesses. Japan has not done that. Okay, America postponed this problem. So it will depend on how each government will want to attack the problem. If they will even attack the problem, or they'll just mask the problem, like Greece did for a long time. Example, Greece has been since 2012-13 in a horrible crisis. We Bulgarians went for a long time to be servants of the Greeks in their houses as housemates and everything else, and ag and farm workers. Things are so horrible in Greece now that they all come to Bulgaria. They're all opening their businesses in Bulgaria. Now, Bulgaria is infinitely better than Greece. Sounds absurd, but that's the reality. And the Greek government has done absolutely nothing to fix their economy. And the Greek economy is going down, 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 and it's getting a lot worse, and it will get a lot worse. And the banks are still closed, they still have the capital controls, nothing has been fixed, and it's going to be getting a whole lot worse from here. Again, you cannot know how bad things must get before the pain, the social pain is so bad and so horrible to force the government to take measures. I mean, that was Syriza, and that was the election, what is it, 2 years ago when they elected a government to take Greece out of the European Union. But then the European Union got them by the throat and said, okay, well, your banking system will collapse and will stop the life support. And the Greeks made yet another mistake to stay in the Union, and things are still getting worse, and the problem hasn't been fixed. Instead, they should have allowed the Europe to stop the funding, to stop the process, to cleanse the system, even if they would have had massive bankruptcies, but that would have restarted the economy, just like we Bulgarians and Russians restarted the economy in 97 and in 98, and we began without that in a lot more healthier way. Now, the Greek economy is much worse than it was in 2012 and much worse than it was in 2008 because they're in much deeper debt. And the economy at the same time is in much worse productivity shape. So the real economy is much worse, and the debt level and indebtedness and overall it's called debt slavery is significantly worse. So it's poised for a revolution. Now, when they're going to stand up, we don't know. Greece is poised to have a fascist government. When and how, again, we don't know. And so is Spain, and so is Portugal. Again, how long the people will tolerate the pain before they rise is a hard question. The Japanese haven't risen 28 years now.
No, that's true. Thank you very much for mentioning that reality will catch up with us sooner or later.
Correct. And governments always postpone the problem to make it later if they could.
That would be a thing for a psychologist to explain. I think it goes for many of us human as well.
Yeah.
Yeah. Thank you very much, Dr. Petrov. Thank you very much for being with us today, and thank you for introducing us to many different topics. Of course, you spoke a lot about things not relating directly to gold, but everything relates to gold, as you explained to begin with, because in order to understand the need to invest in gold, you need to understand the woes of that are inherent in those things that are not gold.
Well, gold has been for thousands of years at the central. It has been the core of the monetary and financial universe. It always has been, and even now it is, even though governments tell us that gold is a barbarous relic. The Chinese government is buying gold and trying to base their currency on gold. The Russian government is buying gold, and other Middle Eastern governments are buying gold. So most of the Asian governments are buying and accumulating gold and preparing to have gold-based currencies, which are a lot more trustworthy, just like the British pound was for many centuries based on silver. It's a silver, and then switched to gold, just like US dollar was silver based for over 100 years until they switched and made it gold based. So every currency has been based on eventually silver and eventually gold, and this has been always, since there have been human civilizations and money, the financial center of the system, and it is still today, even though governments deny it. And it will be most likely based on 5,000 years of history.
Thank you very much.
Can you just please include that? So, dear listeners, we hope that you have then taken into consideration that to protect yourself before the bubble bursts, to find a safe haven, go to gold, because here at Peters Guldkorn, we truly believe that this could be not a permanent solution, but a perfect hedge against.
Well, this is what I've tried to. Yes, this is what I've tried to explain for the last 35 minutes.
Thank you very much. Thank you once again. Mange tak til Dr. Petrov. Det var et fantastisk interessant overblik, han gav os her.